very good evening for everyone who have joined in. I'm Ankit Kanodia from SmartSync Services, a SEBI registered investment advisory firm. Welcome to yet another episode of Mission Smile guest webinars, a new Mission Smile initiative where we invite guests from the industry every month and learn from their unique investing styles. Before we begin, I would request everyone to please keep yourself on mute and switch off the video so that we can have a seamless discussion and soak in all the knowledge. You may type in your question on the chat box. We'll take all the questions in the end. So let's begin. Today our guest is Nick Maggiulli. I hope I have pronounced your name in the right way. He is famous for his excellent blog Ofdollarsanddata, where he writes on investing and personal finance. Nick has recently written a book, Just Keep Buying, and the title of the book matched with the philosophy of what we do at SmartSync Services. Hence, I purchased a copy in the month of May and read it cover to cover. You would find writers who are excellent with data. You would find writers who are very good with narrative. Very rarely you would find a writer like Nick who excels at both data and narrative. I would highly recommend anyone to read this book. In early 2017, Nick made a New Year resolution to write at least once a week, and he has never looked back since then. In fact, today, Nick often writes more than once a week. I'm his fan for 3 years now. Last year, I shared with him my own blog post, and he was gracious enough to go through it and offered me his suggestion. And those were some really good suggestions to improve upon my own writing skills. I can go on and on, but I think I should shut up now, and Nick should do most of the talking. Thank you so much, Nick, for agreeing to do this. If you can start with a little bit about yourself, it would be great. After that, I have a few questions for you. And in the end, we'll have 15 to 20 minutes for the audience to ask a few questions.
Retirement vehicle because of the tax savings. And I actually looked into the data, and I don't think it's a great decision for everybody. I think for some people it makes sense, but for a lot of people it doesn't. And just kind of starting that conversation, I think, is the way to go. So that's a little bit about myself. I've been, obviously, you said, I've been blogging since 2017. It's been almost the end of 6 years now. It's kind of crazy to think it's been that long, but just I take it 1 week at a time. We're at post 313 now. So I've done 313 weeks in a row where I've not missed a single post. And obviously, as you said, some weeks I do more than one, but I do one every single week. So
that's great to hear. And you don't have to explain SaaS to any one of investors now, because we all know about SaaS companies, even in India now, even though we don't have too many SaaS companies listed in India, but all investors today know about, and all of our audience today are investors. So they have pretty good idea about SaaS companies.
Well, so just to clarify, there's SaaS and there's SAS. SaaS is software as a service, which is like a whole kind of separate, huge thing.
Right.
SAS was this little company that was in I think it's in South Carolina or something in the United States, and they just create a programming language. So just to make sure, I don't think there's many SAS companies around.
Right,
just to be,
right.
I think it's a very rare thing. I think SAS is kind of considered a dying language at this point, but it has a place in my heart. It's my first programming language. So
Great. So quickly, I'll start with the first question, Nick. So tell us about your early days as a writer on investing and personal finance. What made you believe that this is where you belong? Any specific incident or person that influenced you to take this plunge?
To be honest with you, the first 11 months were really tough. I mean, I had moments where I put out a post and it would do well, and then I'd 8 or 10 posts in a row that didn't do well, or I didn't really get much accolades, or people didn't really respond much. Imagine people think when you put out work that people don't like, that it's like, oh, you're gonna get a lot of haters and people saying, oh, you're terrible. And that's not what it is. When you put out something that's not good or people don't like it, they just don't say anything. It's quiet. It's silence. You don't hear anything, right? And so in between those once in a while posts that were good, I just had a bunch of silence. And I think the moment for me when I kind of felt accepted and everything was I came out to New York City. I was living in Boston at the time. And so I came out to New York City, and there was a conference where there was a bunch of, people in financial Twitter out here, Michael Batnick, Morgan Housel, et cetera. And the day I met Morgan Housel in person, I was like, because remember, I look up to this person. He's like my favorite writer in finance, etc. And I met him, and he was like, "Man, your writing's amazing. Like you've blown me away in like the last, year, basically." And I was like, "What?" Like for me, that's like, especially now. Remember, this is before he had the book, before his brand's just gone up and up and up. But even back then, I thought he was a superstar, right, writer. And so for him to say that to me, it just meant so much. And I think that was the moment when I was like, I can do this. Like I've been, when you have someone who's that good telling you like they admire your work, like I think it does a lot for you. And so I'm forever grateful to Morgan. He's been a mentor. He's kind of, as I said in the book, I have the acknowledgement sections. Like he just leads by example in a way that I've never seen anyone else do. And so I'll always be forever grateful to Morgan. So
Great. That's a great story. I didn't know about this, about your connection with Morgan. I do remember that Morgan actually praised your book, and I think he wrote something on the cover, on the back cover of your book. So that was
yes, he
also
did.
something really interesting. So moving on to the next question. So Nick, what kind of early notions did you carry with you as a person on personal finance, which you no more carry today, as in something which you think that was not actually right?
Um, to be honest with you, I didn't really have any notions of personal finance, right? Like for me, I mean, I never had to worry about getting food or anything like that. So I was never like going hungry. So I don't want to like, mischaracterize my upbringing. But at the same time, we never had a lot of money. I didn't have a car in high school, and I think that's very common in the United States for someone to have their own car. Um, we would sometimes not, my mom wouldn't have money to pay our internet bill, right? My internet at the time when I was coming up in like the late 90s, I was like 10, 11, 12, late 90s, early 2000s, being on the internet, being on something called AOL Instant Messenger, AIM, that was the biggest thing. You would get on with all the other kids, you would chat and all that. I still remember my AIM messenger name, all that type of stuff, and our internet would not be on because my mom didn't pay the bill or something, right? So for me, I don't think I had any notions. It was just like money was always tight, and so we always had to be careful about how we spent money. But it was never like, oh, I have to worry about food. Like food was always there, but outside of that, like I couldn't go on these luxuries. I never traveled. I think I did get on a plane once, and I flew to Arizona, so that was like my first flight. But after that, like I didn't fly again until like many years later, until I was like in high school, right? So it's like one of those things where I just wasn't used to doing a lot of things that I do now regularly. So I don't want to say that I had any money notions in particular. There's one kind of funny story. When I was, when I was young, as I said, money was tight. So even when every time I went to McDonald's, they was on all the dollar menu. So you'd spend $1 and you could get anything on the dollar menu. So my dad was always telling us to go off the dollar menu. So I never ever order off anything that's not on the dollar menu, right? So as a result, to this day, I still order off the dollar menu, even though I can afford, and I obviously go out in New York City, spend way more. I'll spend like $50 on a steak or something. Yet to the day, I cannot buy something not off the dollar menu because of just like this. That's like a money belief that got imprinted on me. So for some reason, I'm still kind of like, I can't spend $6 on a sandwich at McDonald's. It feels weird to me. So that's an example of something that can kind of, it's completely irrational at this point now, where I can easily afford a $6 sandwich, but I don't do it because of something that's in my psychology.
Great. That was a good story, actually. So moving on, Nick. So you have openly shared your views on your blog and also on Twitter on the topic of waiting for the dip versus buying regularly. And why I'm
Mhm.
asking this is because this is one of my favorite topic as well. Because I personally have lost. So just to give you some introduction, we invest in the. I've been investing in the stock market for last 10 years now, and
Mhm.
in the early years, I wasted a lot of opportunities, or I couldn't capitalize on a few opportunities only because I thought that I'll wait for the dip. And this is something which I made a change a few years ago. And I'm seeing the result already, wherein when you buy regularly compared to waiting for the dip, there is a huge difference. And I know that you have done a lot of data crunching on this. And if you could just expand on the same for the audience today, it would be great.
Yeah, so the reason, I mean, I'm just going to talk about US stocks mostly, but you can do the same thing in international stocks. The reason generally why buying the dip, holding cash and waiting to buy the dip doesn't work. Remember, let me specify the difference. If you happen to have cash and there's a dip, it's always a buying opportunity, right? However, if you hold cash in anticipation of a dip, if you're waiting for a dip, that's very different, and that's usually a bad thing. It's not something that's going to work out for you. The reason why is because dips are rare, and big dips, the ones where that are actually very profitable, are extremely rare, right? If I could just use US history as an example, the last big dip we had was, March 2020. And that was a 33% dip, and it only lasted for like a day. I mean, really, we were like in the high 20s for a while, hit down to 33, and then it was back out real quick. So you had such a small window to capitalize on that. The one before that was '08, which was a massive dip you could have profited off of. There was that slow kind of decline in 2000, 2003. And then before that, you get like 1987. And then before that, you have to go back to like 1974. So if you really look at it, these big dips are pretty rare. They come every decade or so, and yes, you can capitalize on them, but they don't happen that often. And that's the problem. Like that's the theoretical framework. And when I actually run the data, the issue is when you go to try and wait and buy the dip, that dip happens, but it's higher than where you could have bought before. So imagine you could be buying here, 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 here. You're waiting, 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 and then the dip happens. You buy here, but you could have bought all down here, which is still cheaper, right? And so that's the issue. It's like, yes, you bought cheaper than right before the dip, but you still bought more expensive than where you could have bought before, right? You can kind of imagine it as a line doing that. So that's kind of the main takeaway there is if you just think about like that logically, and that's at least true in the US. You're saying, well, Nick, what about a market that's going, sideways for a while? Well, you're not making much money in that market anyways. And I'm talking about mostly, markets that are going up over time. And that's most markets. Of course, you can find exceptions. I can tell you, I know most of them, Japan, Spain, 73 to 1983. I know all these markets that did very badly over long periods of time, but those are rare. So those are equally just as rare as these dips are. So for the most part, asset prices tend to go up over time just because of inflation and a host of other things, people getting more productive, et cetera, technology change. Because of that, like buying dips isn't really profitable. So if you do happen to get a dip and you happen to do something where you're like, hey, wow, this actually worked out for me, then my argument is that's great and glad you did that. Just take your victory lap and then move on. Don't try to do it again. And you got lucky, and that's kind of how I look at it. And so if you ever do get into one of those scenarios, don't keep trying to play that game because you'll lose out. And I can give you plenty of examples of investors who have been calling for bubbles for forever and they've been wrong for a decade, and now they're like finally right because now markets are actually crashing, and so they feel vindicated. And so you can think about Jeremy Grantham at GMO. He's like the head bubble cheerleader, right? He's been calling for bubbles since 2013, and it's like now he's saying there's a super bubble even after markets are down as much as they are, and he's saying we're still in a super bubble. And maybe he's right. Maybe this is a super bubble, but the question is what level are they going to lower to? Like right now, U.S. markets are back to where they were in late 2020. So like December 2020. So basically 2021 just didn't exist. That whole return, all of it gone, right? And that's kind of when there was a lot of speculation, madness and stuff anyways. It was the craziest year I've ever seen. So 2021's gone. We're back to late 2020. How much lower could it drop? Could it go to like March 2020? That would be kind of shocking. That would take us back to like, I think 2017 levels. But we'll see. I mean, we have to wait and see and kind of go from there.
That's a very relevant point, Nick. I'll just take some time to explain to the audience with an Indian example so just bear with me for a couple of minutes. So there's a company called Infosys, IT company in India. It's listed in the Nasdaq as well, so you must be aware of it. There are ADRs of Infosys there, right? So in the 2000 mania, the Y2K mania, March 2000, Infosys was trading at an obscene valuation of 220 PE, and that was the top of the stock. So that is when the stock made a top. So the story which has been floating around in Indian stock market for last many years now is that if you would have bought Infosys in 2000 and you would have hold on to it for next 8 years, you would have made zero returns. So I went back and I did some calculation. If instead of just buying and holding, if you would have bought Infosys right from the start of that Y2K mania, as in March 2000, which was the topmost point of Infosys, and kept on buying till 2008, which was the 8 year of no returns, you would have still made a 13% XIRR on an Infosys.
Oh, wow.
So that is something which doesn't get sold out because this is boring, where you buy the same thing over and over and again. You are still buying seemingly expensive businesses over and over again. I know you have a point related to individual businesses. I'll be asking you a specific question related to that. We'll come to that. But before that, my next question to you. In your recent interview with Vishal Khandelwal of Safal Niveshak, you made a very interesting comment that people remember your victories and forget your losses. You said that in respect of one of your, I think your blog posts, if I remember correctly. So when I heard that, a bulb flashed, as in, wow, what a comment. And I never looked at life in that way. So I would really request you to expand on the same for the benefit of all. What do you mean by that?
Basically, like if I were to ask my biggest fans, like my readers, like, oh, what are your favorite posts? They could probably name maybe one or two. You know, maybe the biggest fan could name like five at most. I can't even. It's hard for me to remember all my post names. So I'm like, remember this post? Oh, I kind of remember. Like I've written 300 of them. It's hard to remember all of them. I'm like, once I start reading, I'm like, oh yeah, I remember writing this. But it's like, it's one of those things where like people only remember your best work or the work that they think spoke to them, right? For example, I've written a post on alcohol that spoke to a lot of people. I wrote a post on, regrets that spoke to a lot of people. I've written a post on even God couldn't beat dollar cost averaging, right? That's a post that spoke to a lot of people. So everyone's going to pick and choose what they like of your work. And no one's going to remember, like if I said, okay, what's your least favorite blog post? I don't remember it. No one remembers that, right? And they're okay with like you're not going to hit a home run every time, and they understand that. Like every single content creator out there are people out there that once in a while have a dud, and it's okay. There's nothing wrong with that. Everyone does it. I can tell you, Morgan will probably tell you, yeah, this piece wasn't as good as my other stuff. Like every single person that's a great writer, Jason Zweig will tell you that. Everyone will tell you that. You're not going to always write home runs and write your greatest stuff, and that's okay. And there's nothing wrong with that, right? Sometimes we think an idea is cool and we really enjoy it and it's good for us, and other people can really like it, but it doesn't mean it's going to get popular, right? So I think it's just keeping that in mind when you're kind of creating content or anything like that, that it's okay if you're not always batting, 1,000, as they say. That's the baseball analogy here in the US. One other thing I wanted to say on what you just said about the Infosys thing, I think it's really interesting you bring up that point because a lot of times when you talk about, oh, we could have bought here and then 8 years later we have no return. Nobody invests like that. It's very rare that you put all your money in once and stop. Of course, there are exceptions to that. Let's say you sold a business and you have a big lump sum, you put all in. There are exceptions to that. But for the most part, most people are buying over time. And the reason why we don't look at that over time analysis is because it's much harder to run. It's very easy to calculate a period return. Like here's the starting number, here's the ending number. Final over initial minus one equals your return, right? Very simple. And so in the case of Infosys, the final number in '08 over the initial number minus one is zero. It's 0% return, right? But for you to calculate the dollar cost averaging return, you have to calculate every single one of those changes from the end to those beginning points and then average them out over the purchases and weight them if you have different dollar amounts. After doing all that, that's very complex. You need a computer to do that. You need to do an Excel file or something. And because it's so complex, no one does it or very few people do it. And so it's much harder for us to like, visualize that or understand it. So I think that's one thing to keep in mind is most people don't invest in snapshots. So, and I even show in the book, like everyone talks about Japan. I was like, if you had started buying into the Japanese stock market starting in 1980 and you kind of did that for the next 30 or 40 years or whatever it was I did in the book, you would still come out ahead after. I mean, of course, it wasn't a great return. I'm not going to lie. You didn't make a lot of money, but you still beat your cost basis, right? And so it says, at times you're above, at times you're below your cost basis. So you're kind of moving around that. But even this is one of the worst stock markets in history, and you still would have done okay if you had bought over time.
That's right. I completely agree with you here. So now I'll pick my personal favorite writings of yours, and I'll pick three of them one by one. I start with just keep buying. No, I'm not talking about the book. I'm talking about this post which you wrote in April 2017, exactly 5 years before you launched your book with the same title. Tell us in short about your thought process that went behind writing that post. I know that in the book, you have covered a lot more than what you wrote in the post. So restrict yourself over here to the blog post at the moment and give some thoughts as to what went into the writing and what do you want to say when you write that kind of a post.
Yeah, so when I wrote that, I kind of was just like, you know what? I have all this information from different sources that are saying the same thing, right? There was this example of Bob, the world's worst market timer, which I didn't know at the time, but that came from Ben Carlson at A Wealth of Common Sense. So that was his idea of there's a guy who just buys at the market peak, saves up cash, only buys at the peaks. He literally buys at the worst time, right before a crash, right? He buys in 1987 before the crash. He buys in 2000 before the crash, buys in '08, etc. And even if he does this throughout his career, he still makes a very good return. Like despite being the worst market timer, because he never sells, he just keeps buying. He actually makes money, right? And this is obviously a very extreme example. That's kind of biased against the investor, Bob in this case. Yet he still makes good money. He still has a great return, right? And so that was one example in there. I had my own data I was looking at saying, look, here if you have you're looking at 1 year returns, like, yes, it's kind of all over the place. But as you kind of go to over 30 years, no matter when you bought, it didn't really make a difference. Like your annualized returns were still positive. Obviously, there was a difference between, difference between 4% and 6% over 30 years is a lot of money. Don't get me wrong, but it's still positive in both cases. And that was kind of the point of the charts. And I had GIFs and all sorts of stuff in there, which I obviously can't do in a book. It's very hard to do a GIF in a book, at least as of now. So because of that, that's kind of how things came out. But yeah, that was kind of what I was thinking at the time. I had all these different examples. I said, what's an overall philosophy I can use to write about this? And I think just keep buying was the solution. And I didn't know that was going to eventually be the title of the book. I remember when we were first writing the book. So it's kind of funny. A quick backstory for that. It was December 2020. I pitched Harriman. I slid into their DMs on Twitter, said, hey, I want to write a book. And they're like, yeah, we know who you are. Like, we thought, like, give us your ideas. And so I had two different ideas. The first idea is what became Just Keep Buying. And the second idea, we're kind of on the back burner. I might write it one day. We'll see. But they independently had the same idea. And the idea was just to answer a bunch of questions. That's what Just Keep Buying does. Every chapter, I'm basically answering a question. If you look at the table of contents, you'll see that pretty easily, right? So, but before we actually titled the book, this is a fun kind of inside information. Harriman was there. We were going back and forth on titles, and they were saying something like, a data scientist answers the 15 biggest questions in finance. And I was like, that is absolute, no one's going to buy that. Data science, okay, half people are turned off, answers the biggest, I'm like, oh no, that's terrible. And I was like, you know what? We're going to call it Just Keep Buying, because that's like my investment philosophy. It comes out, has to do with like what I wrote about. I was like, that's it. That's the thing. And I can talk about the data after. The data can be discussed after the fact. I don't want to lead with that. I don't think it's going to get people excited. So I was like, this is the title. I'm pretty sure this is it. They were unsure about, I don't know if that's going to, I was like, just trust me, this is the title. And it's been selling better than I've expected. So it's been doing well.
Great. Nice to hear some inside stories about your book. So my second favorite writings of yours is that I'll just read the title again. We begin our lives as growth stocks, but end our lives as value stocks. What a title. I really love this title. So tell us about this one now.
So that post actually made it into the book as well. It's in the conclusion, right? So all the greatest hits kind of made it in. And the reason I'm using obviously blog posts and putting them into the book is because, like, most people haven't read my blog. Most people don't read blogs. So putting that stuff into a book allows me to reach a wider audience. I get people to read my work that have never read it, would never read it if it wasn't in a book format, right? So, or audio format of some sort. We had someone also do an audio book. But the whole point of that post was, if you actually look at the happiness data, and researchers have asked people, when people are like, they're late teens, early 20s, they have all these aspirations. They have all these beliefs about what their life's going to be like, when they're 30, 40, etc. They have all these ideas. But as kind of life starts to happen, they realize that all these things maybe didn't happen in exactly the way they wanted. Maybe some parts of their life are better than they expected, but there's all the other parts of their life that aren't as good. So they kind of have this really high fantasy for themselves in their life, and it doesn't come true. And so we see we're kind of like growth stocks. And that's what a growth stock is, right? We believe the earnings are going to go through the roof. They'll keep growing forever. We'll be super rich, et cetera, right? It's the next Apple. It's the next Amazon, et cetera. But we come back down to earth at some point and we realize, oh, that's actually not true. So we begin our lives, begin our adult lives as value or as growth stocks, right? But what happens if you look at the happiness research, people then start to overcorrect and they start to get really down on themselves. That's what this whole midlife crisis, middle-age crisis, whatever you want to call it, that's where people are down, they're buying sports cars, all this type of stuff starts to happen, right? They're not happy about their lives. But what tends to happen then is that people actually overcorrect. They're too down on their future and they get all these. And so what ends up happening is they actually get all these little upside surprises they weren't expecting. And so they end up having more happiness than they would have thought. So that's kind of like a value stock, right? Value stocks are so beaten down. They've been beaten down for a host of reasons. Maybe the earnings aren't good. Maybe the management's not great, whatever. And so the market beats down on them. However, any sort of little upside surprise really raises them through the roof. And that's how value over time has beaten growth. At least that's one of the many theories out there, right? And so I just realized that these corollaries made sense. We start our lives as growth stocks, high expectation, and then we kind of beat ourselves down, but then we're value stocks and we tend to do better than we expect late into life. And so that's kind of the main takeaway there. And I thought the happiness research made sense. And I thought, like, between the happiness research and what I was seeing in the markets, I was like, oh, this is a perfect corollary for understanding our lives. And so I talked about my example of, like, I had a bunch of friends that are millionaires now because they were, I don't know if they're still millionaires because the tech bubble or tech's down pretty bad right now. So maybe they're not millionaires. Maybe I spoke too soon. But when I wrote the post, they were all millionaires. They had equity from these companies and all this and all that. I don't know if they sold it all, but either way, we're here today. And so it's just kind of interesting because I didn't take the tech route like a lot of my friends did. And so I was kind of feeling weird about that at the time. And, I don't regret that because I got to write something I care about and I kind of becoming myself, but it was still an interesting way to kind of think about the world.
Yes. So moving on to my third favorite, um, the problem with most financial advice. And coincidentally, again, this one also features a lot in your book because you have given lots of examples where the financial advice, which is generally out there in the market, is not actually good for you. So I would like you to expand a little more on this because this is very interesting for and important for all of us over here.
Well, the issue with money compared to like some other domain, let's say like, I don't know, being a basketball star or being a sports star or a great, concert violinist or pianist or something, right? The difference between those is we know with certainty that someone who's like good at basketball is good. Like we know, we can see the skill, right? We can see it, right? With someone who's playing good violin, you can't fake that. You can't just instantly wake up and be a great violinist, right? It takes time and effort and dedication, right? The thing about money is someone could have gotten rich and it could have nothing to do with their skill. They could have just been born rich because rich parents, they could have hit the lottery. There's tons of ways in which people have money. And so once you have the money, you can then explain why you have the money. But that's not necessarily true, right? Because you can be like, oh, I did this, this, and this. And maybe first, I'm not saying that everyone that's ever explained how they got rich is wrong. I'm not saying that. But there's a lot of people that tell you, oh, here's what you needed to get rich. And they got rich in a different way, or they don't even realize how they got rich, right? Like, and I would say there's a lot of people out there where it's like, oh, they're teaching trading courses, for example, about how you can get rich, but they didn't get rich from trading. They got rich from selling trading courses, right? It's like a very interesting game where it's like, oh no, how I really need to get rich is convince other people to give me money about trading courses. It's not actually about, trading, right? And so I think that's a simple example, but you can generalize that. And most of the financial advice is given by the victors. We don't really know if that advice is what got them rich, right? We can't test it. What we really need to do is we need to, and this is why I get so upset with the mindset stuff. Like, oh, everything's your mindset. I'm not saying mindset doesn't matter. That would obviously be false, right? But we've never really been able to test it. How do you do a randomized control trial of mindset? Like we get, okay, these 10 people, we're gonna put a chip in their brain and change their mindset, and these 10 people are not, and we're gonna see how their wealth grows over time. Like, we've never done something like that, and that would probably not even be ethical. But I'm just getting my point is like you can't test mindset. So it's an easy way to say, oh, it's all about your mindset. The reason you're not rich is your mindset, right? It's an easy cop out because you can't prove that it's mindset. At least with the stuff I'm doing with data, I could say, look, the data shows X and this is actually provable. With things like mindset and behavior, it's much tougher. And so I'm not saying that stuff doesn't matter, but because you can't prove it, it's really difficult for me to like support a lot of those theses when we can't show that they actually make a difference. So that's kind of the problem with most financial advice.
Right. So, Nick, while I enjoyed reading your book, Just Keep Buying, and you have covered a fair bit of it in your blog post as well. However, there is one chapter which I read at least 3 times because I personally do not agree with you there. And that is why you shouldn't buy individual stocks. And today in this audience, you have at least 90% of people who invest in direct stocks. So please, I'm not trying to debate you on this. I just want to hear your side of the story. Please try to convince us against investing in direct stocks.
Okay. So I think the issue with this discussion as well is there's so many different ways to invest in individual stocks. And so let me just preface that. There's one way to invest in individual stocks, which is put, 80% of your wealth in one stock or two stocks, right? And maybe 20% is in bonds and other things, right? That's one way. Then there's a way of, oh, I own 50 stocks in my portfolio, right? That's technically owning individual stocks. Those are both individual stocks, but they're very different. I would say by the time you get to, 25, 30, 50 stocks, you're probably more diversified than you think. But let's not even get into that. That actually matters. So if I'm guessing most of the people here own more than like two stocks, if you're putting all your money in just two stocks, I think even you would probably agree that that's may not be the best idea. But let's put that aside for now. There's two arguments. The first argument, which I'm guessing most of the audience has heard already, is the performance argument. You're unlikely to beat the market, right? So why are you even spending time doing this? You're probably unlikely to beat the market, right? So that's the argument that everyone's heard. You actually look at the data, it's very clear. It's somewhere between 70 to 80% of managers, professionals, these are professional money managers, cannot beat the market, right? After fees and everything, and especially over like 3 to 5 year periods. That's generally true. So that's one piece of it, but let's put that aside. That's not even the argument I want to make today. I want to kind of go back to an argument I just made kind of a second ago. I was talking about basketball players, violinists, etc. It's how do you know you're good at stock picking? Now I know a lot of the people on this call, they might like doing it for fun. They just find that there's a thrill, there's enjoyment. That's fine. I'm not against that. If you want to do that with 5-10% of your wealth, fine. Let the other 90% be in index funds. Be prudent. Just in case you're wrong, there's no real financial downside for you. That's my argument, right? So if you're doing it for fun, whatever. But let's say you're not doing it for fun. Let's say the bulk of your wealth is in individual stocks, right? I will say to you, how do you know you're good at stock picking? And the fact of the matter is the amount of data you're going to need where you can statistically prove that you're good at stock picking is much larger than you think. If you think, oh, these stocks went up and I did really well, like all you can have is all you have to do is get lucky on one stock, right? You can own GME in late 2019, or I'm sorry, late 2020, have some theory about the world, right? Oh, this GameStop's going to go up because they're this and that, and then early 2021 happens, all this stuff goes off, and then you're like, oh my gosh, this is a very different thing than what I thought originally, right? And so you will realize kind of how much that will influence you, right? So it's like you can get lucky and then just do well, but you have no idea if that was because of your skill or because of luck, right? And so that's my argument. It's just too difficult to identify in any short period of time if you're skilled. And so obviously if you're doing it for fun, as I said, do your thing. But if you're trying to do this like professionally or that's like how you're managing your family's wealth, I think it's really difficult to know if you're good. And you have to do this for a very long time before you will know. And then even then, what if you're good in one market regime, but you're not good in another? For example, let's say you're really good during bull markets, but you're really bad during bear markets, or vice versa. You could be bad during bull markets, but really good in bear markets. And so because the information is always changing, you're always going to have even the best money managers underperform. Like I talk about this in the book, like the best money managers, people that are like legends out there, they've all have periods of underperformance. So how do you know the difference between when you're going through a typical lull versus when you're like, oh my gosh, I've actually lost it. I don't have skill anymore. So those are the questions I have. And that's kind of the questions I would open up to your audience. It's like, how do you know if you're good? And I think it's really difficult. This is not something like a chess game or a basketball game where you can kind of tell pretty quickly if you have skill. This is something where because there's so much luck involved, it's difficult to know. And so that's kind of my argument there.
I agree with you, Nick. There are some fair arguments made here, and I'm not going to debate you on this. This forum right now is not to debate on that particular point. It's just that I just want to make one comment here, is that even if you have to wait for some time, and as you rightly said, you may start with a small portion of your capital, maybe start with 5% and 10%. And over a period of time, good investors will come to know whether they are good at investing or not. I agree to a point that, okay, if I start in a bull market and I get good returns, and then later on in the bear market, I realize that, okay, I'm not good for bear market. So those things are obviously there. But it's just like, say, for example, I'll give you another example outside of investing. If you think you are good for cricket, so I don't know, I'm not sure if you follow cricket so we are cricket crazy nation. So there's a cricketer called Dinesh Karthik in India, who has been an excellent wicketkeeper batsman. And he has been perfecting his art for so long. And he still never got a chance to play in the national team. And after 18 years today, or maybe a week ago, he got his name announced that he's now in the team. So I personally feel that even if you don't make great returns, even if you don't become the best of the investors, if you, while in this journey of researching and investing in individual stocks, feel that, okay, you have something, and I know that it should not be just for fun or entertainment. It's just that you are really passionate about it. I think it makes sense to go with your gut. Of course, you may be proven wrong later on. That's a different thing. But I totally agree with the point which you are making and from where you are coming from. But since I had my own personal bias, I am already investing in individual stocks. So I had to go through that portion of the book at least 3 times to see why you are saying that, and why what wrong am I doing, which I think I should look at. So that is the reason I asked you this question.
I love that argument that you made because you're right. If you're passionate about something, I'm not telling you to not be passionate. I don't want to make you like, oh, you shouldn't like this. Like, that's not what I was doing. I'm trying to get the people that are on the fence that are like, oh, should I buy it? Like, they don't know anything. That's who I'm trying to talk to. The people that don't know much. It's like, oh, should I do individual stocks? Should I not do that? I'm trying to get them like, just do this. It's much easier, right? But the people that are passionate, they're looking through 10Ks, they're doing this, they're on calls, this. If you're into that and you love that feeling, you love being a shareholder of this community, you love that, I can't take that away from you. I don't want to take that away from you, right? So in that case, do your thing, enjoy it, right? Enjoy life. You only get one life to live, so I would never try and stop someone from doing something that they enjoy. So maybe I should have prefaced that in there. I should have talked more about the fun part, but I was just trying to get those people that are on the fence that are kind of like, maybe I should do this. Just I'm trying to get them like, don't waste your time, move forward. There's going to be a whole set of people that they love this thing, and no matter what I say, it's not going to matter. And so actually it doesn't, I actually don't need to say that in the book, because if you truly love it enough, no matter what I tell you, you should still be in, right? If I convince you to stop buying individual stocks, you probably didn't love it enough. So I actually think what I did actually makes sense now, because, if you're, as you said, you read it 3 times and I still couldn't convince you, you probably love this stuff. So cheers to you.
Thank you so much, Nick. That was really well, very well explained. So now moving on. Now I would like you to talk about some of your big mistakes, if you really did make some mistakes. Of course, if you can tell about your money mistakes or finance mistakes, or even if it is not related to money and where you learned a lot from it, it would be great for us to
Yes,
know.
of course. So to be honest with you, my biggest mistakes are just every time I just deviated from the stuff I've said in the book. Like I had a chapter. I had already written the chapter called Why You Shouldn't Buy Individual Stocks, right? And last year I took 1% of my net worth. So I took a very, very small percent of my capital, right? And I put it into 2 individual stocks. I basically split it. And they're both tech stocks, and they're both down very badly. One's down like 80%, and the other is down like 90% or something. They're just beaten down right now. So that was an investment mistake. Obviously, it's only 1% of my capital. It's not going to really affect me in the long run, right? But it's just an example of like, I put in some money in there I shouldn't have done, right? That's one mistake I made. Another mistake I made earlier this year, I went and, crypto's been was crazy last year. I said, you know what, maybe I took 0.5%. So I took 1% for those stocks. I took 0.5% of my capital and I put it into these little altcoins, right? These random coins. A friend had recommended I put them in there. Those went down so badly and I sold. I think those were down like 70% each and I sold those out. I was like, okay, I know this is crazy, right? So those are examples of my mistakes I made. And what were the mistakes? I knew I shouldn't have done that. Like I wrote a book on this. I mean, my book was being published 3 months later about why I shouldn't do this type of stuff. And I did. Of course, I was like, you know what? Maybe let's just see what happens. Because if it goes up 100x, like you make a lot of money, right? Even so, I took one little bet, made these tiny little bets. And so they weren't major mistakes. They were paper cuts. So my recommendation to you, my advice is, if you're going to make mistakes, make sure they're small, right? That's the main thing. Don't ever make huge decisions. I think that's where people get in trouble when they do all or nothing things. Oh, I'm 100% in stocks. No, now I'm 100% in cash. That is almost always a disaster, right? Because you start doing these things. Of course, you can get very rich doing that. If you pull out right before a crash and you buy it, put all it in at the bottom, you can get very rich if you get lucky. But most people aren't going to do that. So that's why I say, don't make big decisions like that where you're moving everything at once and moving it back. That's where you start amplifying your risk. So in my case, I made mistakes, but I kept the risk under control, and that's the main thing. Just like in the book, I talk about this. The guy who bought GameStop, my friend of mine, yes, he lost $12,000 in 2 hours, which is a lot of money. It's no joke. That's a lot of money to lose, but of his total net worth, it wasn't too much, so he was fine. He put a couple percent in, and he played the game, and he lost, and that was it. And by the way, I've had people read my book and say, "Oh, he said the reason not to buy individual stocks is because of GameStop." Like, no, that's obviously not true. That's an extreme example. I just wanted to show it because it was you kind of got an entire like years of experience in 2 hours, and I thought that's why it was kind of cool. So just to let it be known out there, it's not because of GameStop that I'm like, you shouldn't buy individual stocks. I've tried to articulate my theories outside of that.
And I think what you have written throughout your book also kind of says the same thing, that what do you mean by just keep buying? You're not putting all your money at one point of time, right? When you're just keeping buying, that means you are buying at every level, and you are buying progressively. As your income grows, your saving grows, your investment grows, and you buy over a period of time. So that is also taking care of all these big mistakes. Even if you started buying, say, something like 2000 top or 2007 top, even then, if you started buying and you just didn't stop there, you are not going to lose money at all, right?
Yeah,
That's
so
a
the
very
idea it's all about diversification, right? So I talk about diversification of your asset classes, right? Diversification, there's levels of this, right? There's diversification across asset classes, owning stocks, owning bonds, owning real estate, owning farmland, whatever, right? Then there's diversification within an asset class. How many different stocks do you own, right? So S&P 500's 505 or 500 companies, 505 stocks, whatever. And you can keep going from that. The buying over time, that's time diversification. So you really look at there's different levels of diversification that's occurring within, the investment space. And so that's what I'm always trying to do is get people to have some balance to de-risk in different ways because risk can sneak up on you in a host of ways. And so just trying to do that, I think, is what's important. Non-finance mistakes I made, just to kind of follow up on this. I wish I just started exercising more when I was younger. Wish I'd hit the gym more. I wish I, started working out earlier. I just think it's one of those things that compounds in such a big way. And it just, your overall life, if your health is good, everything else is built on health. And so I know we talk about wealth and all this stuff, but if you can amass all the money you want, if your health isn't good, what's the point? You're going to die early. You're not going to enjoy it. There's a ton of reasons why you should exercise and focus on that. I think even now, I write about money every single week. Most of my time spent in my free time thinking about stuff is thinking about health and nutrition and stuff like that. I'm not thinking about money that much anymore, to be honest with you. Obviously, I've been working for a while. I've been saving diligently. So I have a privilege to say that because I've been, making the right choices for so long. But for me now, the things I'm trying to fix are my health and wellness and all that.
great point. So now moving on, who are your favorite writers? I know you have already talked about Morgan Housel, and we all are big fans of Morgan Housel. So apart from Morgan Housel, who are your favorite writers from whom you learn and interact the most?
So the new writers that I like, that is probably because I could tell you, oh, Jason's why. I could tell you all the famous people. I'm not going to do that because you guys know all of them. I'll talk about the new writers. There's one named Katie Gaddy Tassin. I don't know what's her last name. It's Money with Katie. That's the name of her blog. She actually has some cool ideas she comes out with. So on her blog, and then there's Jack Rains. Those are my two. I think they're both younger than me. Yeah, so they're both younger than me, and they're both great writers, and they're in the space, and I love what they're doing. So I'd recommend them. There's also a guy named Rob K. Henderson. He's non-finance, so Jack and Katie mostly write about money, but there's a guy named Rob K. Henderson. He has a really interesting background and everything, but he writes about status, and he writes about status in terms of social status and economic class and all that type of stuff. But so yeah, Rob K. Henderson, he's pretty good. I would check him out as well. He's probably one of my favorite Twitter follows because he's just always sharing just such interesting stuff. He's reading so much and he's just sharing the best stuff he finds. And I just love that. I love what he's doing with his channel. Or with his Twitter account. So I'd recommend following him as well. So those are a couple people. I mean, I could keep going, and if you kind of give me more specific, topics, I could dig into that more. But those are just some high level people I'd recommend. Money with Katie, Jack Rains, and Rob K. Anderson.
Not heard of them. I'll
Mhm.
definitely check them out. Thank you so much for suggesting. So next question, Nick, would be, since you are an excellent writer, I think it is fair to assume that you are a voracious reader too. So top 2, 3 books that you think that have helped you become a better investor or a better thinker. It need not be investment books. It could be non-investment books as well.
Yeah, so I'll talk about non-financial book. And actually, I'll tell you a quick story. So when I told this story earlier when I said it was, about 11 months into my blog journey, I came out to New York to this conference, met a lot of Twitter people. I met Jason Zweig there, and he was signing copies of his book, Your Money, Your Brain. So he signed my copy, and I asked him, I said, hey, I'm a young blogger, obviously, I'm trying to break into the space. What advice would you give me? And he said, read a lot, but not about investing. He said, that's how you're going to become a better investment writer because you're going to start connecting different things. That's how I connected the happiness research with the growth stock and value stock. That's how I connected other things, to different ideas I've had over time. Right. And so, because of that, I started reading a lot of stuff. And so one of the best books I've read that is not about, finance is called Deep Survival. So I would check that one out. It's called Deep Survival. And it's about how people survive in the wilderness, or people were they've been on a ship and the boat sinks because it gets the waves overtake it and it sinks. And so now the guy's surviving on a raft or something, right? And it's just thinking about that. I think there's you learn a lot about resiliency, and I think there's a lot of applications to markets and how people think about investing. And so I think there's something to that. I think it's just a great book too, as well, that you can learn about. So my favorite investment writer is William Bernstein. I mean, only because he got me into the space. I mean, I would say Morgan's the most entertaining and the best investment writer. I mean, him and Michael Lewis, basically. But in terms of like who actually got me into the space, it's William Bernstein in terms of the technical nature of his work. So he's got, the 4 pillars of investing. He's got the Intelligent Asset Allocator, which is probably the book that really kind of opened my eyes to asset allocation and really changed how I looked at things. David Swenson's great. There's so many great investment authors out there. I mean, I could just keep going down. Sharp obviously had a lot of great stuff. I'm trying to think of who else I would throw in there. And it also depends, because when I talk about investing, I mean, investing is a very specific type of writing, and then there's personal finance, right? And there's different personal finance personalities out there. Like I like Tiffany Alici a lot, Get Good with Money. I think that's obviously it's more basic. It's not as like, the high level investing stuff that we talk about, but she has a lot of different philosophies in there that kind of challenge, basic wisdom, right? For example, paying down debt. They say there's 2 different philosophies, right? You pay down your highest interest debt first, or you pay down your lowest balance debt first, right? So you have a low balance debt, you kind of get rid of that one, and then you kind of get mental motivation to get rid of the next biggest, right? Instead of just going after the highest interest rate debt first, right? And she's like, why don't you do both? I think there's something to kind of testing both and seeing if once you get the motivation, you can do this, then just switch to the highest interest rate debt. So she's kind of has a mixed model, which was kind of cool. And I hadn't seen anyone talk about that before. So these are different examples. But yeah, if you have more questions you want to ask about that, I can kind of dig deeper into that.
Sure. So I think I'll take some questions from the chat box now. So I think Manan has a very good question. Manan has written, what is the strategy for someone who doesn't have regular surplus cash flow with capital already invested?
So you don't have regular cash to invest? Is that the issue?
Yes. So you have a fixed amount of cash which you have already invested, right? And now every month you're not getting any cash flow. So what would you suggest to a person like that? That's a very intelligent question, because many people face that situation actually in the market.
Yeah, so I mean that's tough, because I mean there's not much you can do as long as you're managing your portfolio sufficiently. The only other way to do that is if there's any possible way for you to increase your cash flow, and that's not immediate. It doesn't need to be an immediate thing, but it's something you can do over the course of a year, 2 years, 3 years. And the example I give, I was writing on the internet for 3 years basically and made no money. I didn't start really making any money on ads and stuff like that until 2020. So it took me a couple years before I started making money. So 2017, 2018, 2019 basically made zero, right? So it took me a few years to get there. I think there's other businesses out there where you don't need to take 3 years before you finally start making money. I think that's a little extreme, but I think there's things that people can do where they can start making some sort of side income and use that to start to kind of, bootstrap your capital investment. Of course, that's not an easy answer. It's tougher than other things, but I think if I had to guess, that's what I would recommend you do if you have time. And of course, it's tough. Not everyone has time, but I just know in the US, people are like, oh, I don't have time. It's like, well, let me see your smartphone. And I say, oh, you're on social media for 2 hours a day, and you're telling me you don't have time. So I'm not saying you need to spend every second grinding and hustling and all that, but like to think you couldn't take 30 minutes a day to start building equity in something, I think it's not necessarily true. I think everyone can probably find, not everyone, but most people can find probably 20 to 30 minutes in their day to do something to kind of contribute to their earnings and future earning potential.
Anand, do you have a follow-up? You can raise your hand and I'll unmute you, because I think this is a very important, and or maybe your answer is maybe Nick has already answered you. Can you hear me? Yeah.
Wait, I got the answer. Okay, that's good.
Manan has said that he's got the answer. Great. So anyone else with any questions, you can just raise your hand. Okay, I see Gautam raising his hand. So Gautam, you can go ahead. I am unmuting you. Yeah, please go ahead.
Hi, Nick. I have few questions. Like, I'm an active investor since 7 years, and I kind of, I'm very passionate. So I kind of, maybe not necessarily agree on some points you mentioned. Because since last 7 years, I've seen what happens in market, and as you know, there are a lot of constraints for these index funds. So that is one concern I have investing in index funds. Rather, I prefer to invest in maybe 3-year low of index constituents, 3-year or 1-year low, and by looking at the fundamentals, cash flows, etc. And I'm also extremely diversified. So you can't imagine how much diversified I am. So my philosophy is like harvesting. You know, you invest something, and after a few months or after a few years, you know, you get that crop and you harvest it and, you know, rotate that and you grow. So you have something every day, or you know, as long as the market, you know, supports you. Of course, if the market collapses like what happened during COVID, or you know, or May and June, we can't do anything. But still, if you have cash, you can still invest in that period, right? So buying the dips is the most, I think, the best thing we can do if you're an active investor. And finally, you gave an example that, you know, you invested.
Sorry to come in. Do you have a question, or you are just mentioning what you are doing? If you have a question, you can just ask the question.
No, that's question only, right? So I'm asking about index funds, investing in that, and also about diversification. So I just want to hear his views actually.
Okay,
Gautam,
so
hope you got the question, Nick, or do you want me to reframe it?
so he talked a little bit about buying the dip and saying, okay, you know, when the dip happens, you can really take advantage of those things. I agree if you happen to have cash, right? That's generally a good idea. I taught this is chapter 17 in the book. I say why market crashes are buying opportunity. However, the question is, why didn't you take that money and invest it sooner? I'm guessing you just, that money doesn't just appear. I can't just say, oh, there's a dip. Let me go find random $10,000. It doesn't work like that, right? Like you either have to already have the money somewhere, or you have to pull it from something in order to buy that dip. And so the question is, what are you doing? Are you selling out of one position, buying another? How do you make sure that the thing you're selling out of doesn't, you know, that's always the question I have. And so just thinking about that in terms of diversification, like of course, I think people buying individual stocks can be diversified. So I've kind of prefaced that before. So I'm not necessarily against individual stock investors if you own a bunch of a wide array of investments. In terms of the indexing question, like there are things to be said about how they index, and like there's specific like differences, and okay, well, they're too restrictive in what they do, and you don't like all that, that's fine. I think for the most people, that's a marginal difference. I don't think it's going to make that much of a difference whether you do an index investment or something else. I think, you know, most of the time those things will, I mean, most individual investors, I mean, I think about it in aggregate, all the individual investors are what make up the index, right? All the buys and sells and all that, they basically all come together in the index. So some people are going to beat the market, some are going to underperform, right? Most people are going to be pretty close to the market, right? And so to think you're going to have this return vector that's completely different from the market is, I think it's really difficult to do that. And I think there are people that can do that, but it's really difficult. So I think most individual investors won't have that. So it's just like much easier. I don't have to spend any time thinking about my investment strategy. That's another thing which I don't really talk about with this whole individual investing thing. It's like I just buy the index. I don't waste time on that. I can spend my time writing blog posts and other things and doing stuff that's going to create money for me, because every hour I spend looking in the market does not generate any money for me, right? I just put it into my index funds and I'm done, and I can spend my time over here and actually make wealth and do my stuff. That's why I still have a full-time job, right? That actually pays me, you know, because like I'm very talented at data stuff, and my data work is going to pay me a lot more than every hour I spend analyzing some individual stock, right? So I also want you to think about the return on your time spent. And so that's another thing we need to consider. So I'm not against people doing their own research. Obviously, if you're passionate about this, have fun at it, but there's more to it than just, you know, the whole like, oh, I'm just going to, you know, buy individual stocks. I hope that got at your question a little bit. I don't know. It wasn't. Yeah.
That's a fair answer, actually. So I'll move on to Kailash now. Kailash, I'll just unmute you. Yeah. Now you can ask your question.
Yeah, hi Nick. Actually, very happy to actually ask you a question, you know, actually in person. So now my question is actually this assumption of that actually one should not actually invest directly and one should be actually diversifying into the index funding. So does this thinking have got any, you know, actually impact from since last 10 years? US actually market cap to GDP ratio has been, you know, actually 150 to 200%, and whereas actually, you know, so efficient. It has almost become like a efficient market. So actually there isn't actually much room actually in looking for the looking for the inefficient things lying So whereas in India, actually, there could be a lot of inefficiencies. There could be a lot of gaps. Actually, one can actually capitalize. So should I believe actually that since US has been the kind of a in an overvalued zone, so actually does it actually have impact that the thinking or it's applicable? If somebody actually in US in 90s, in 80s and 90s, actually he could have easily actually opted for the direct investing. So any thoughts on that?
Yeah, so I think let me see if I got your question correctly. You're saying, hey, the Indian market isn't as developed as the US market, so there's more inefficiencies to take advantage of. That's a fair argument. I actually do think that's a decent argument. And the reason why is because if you let's look at what happened. Let's look at the history of US stock market. Warren Buffett could literally go out and buy something called net nets. I don't know if you guys have heard of net nets. Some of you probably have. These are basically companies where the net liquidation value, the net asset value, after you take all the stuff and you just, let's say you bought the company and just sold everything, just sold this tractor, this thing, whatever, say it's a farming company, you sold everything off, sold the land off, it would be worth more than you could have bought it for. That's like buying a suitcase for $50,000 or 50,000 rupees and there's 100,000 rupees in it. It would make, it'd be crazy. You would go, what? Who wouldn't buy the suitcase? Everyone would buy the suitcase. That's called a net. So basically net nets used to exist in the US and they were all over the place. You could literally get the newspaper, look them up. That's how easy it was to make money, right? I agree. Is it possible that's where India is today? Yes, I do agree that it's possible. I don't know the Indian markets. I don't know all the international markets as well because the U.S. markets are so obsessing already. It's most of the money and most people are talking about. I have to really focus on those. The question is, how long is that going to last? So yes, many of you on this call will be able to make money doing that, but at what point is it not going to be true anymore? And so that's what I worry about. It's not, okay, the next year, 2 years, whatever, but if you keep doing this 10, 20 years, at some point you're going to be like, oh my gosh, there's no more squeeze, there's no more juice in this, in this fruit to squeeze out. So what am I going to do, right? So the question is, how long is that going to last? So I'm not, of course, like I do believe efficiencies matter, and in international markets, there's probably more inefficiencies that you can capitalize on. So that's something I didn't really address in the book, to be honest with you, but I agree with that sentiment. The only question is, how long will that last, and how will you know once that's gone? And that's the hard part. That's the real question you're going to have to answer for yourself, because at some point, I can guarantee you the Indian market will be very efficient. I don't know if it's there now, if it's going to be there in 10 years, 20 years, but at some point it will be just as efficient, if not more efficient than the US market. So that's what I'm kind of waiting for.
And before I take more questions, I just want to clarify what Nick is trying to say here. He's not against direct stock picking. What he wants to say is that a majority of the population is pretty well not buying direct stocks. That is the main argument he's saying. If you can find inefficiency and if you can be very good at it, so we'll not take any more question on that particular point because we already have a lot of question on that point. So any other point, Kailash, you had to ask, or this was the only question?
No, actually, fair enough. Actually, and just Nick, you mentioned actually when you will come to know that it's very simple. When there's a blood on the street, or when everybody is greedy, when everybody is fearful. So actually, it's very simple. Nick, did you got me? Actually, so when I will come to know that actually when the market is absolutely inefficient, actually, when there would be blood on the street, or when everybody is greedy. Everybody is fearful.
Oh, you're getting at a time. Okay, you're getting at a behavioral efficiency, which I see what you're getting at. So I guess that kind of happens in the US. You would say, like, okay, like for example, in March 2020, that was an example where there was, quote, blood in the streets. People were overly correcting, overselling, or overbuying, and you can kind of take advantage of that. Okay, so that can happen. The problem is the timing's tough. I think right now, I mean, look at in March 2020, did we know that March 23rd was the bottom in the US at least? I don't know where it was in India, but did we know that? I don't think so. I don't think we knew. I think there was a lot of people thinking it was going to keep going down further. And so I think because of that, like, it's tough to know. So I agree. You're like, oh, this is a bargain, but you don't know if this bargain's going to get even more of a bargain, right? When, it's like, what do they say, that stock that's down 90%? That was a stock that was down 80% and then got cut in half. It went down 80 and then another 50. That's what a stock that's down 90% does. So just to kind of give you can think you're getting a deal and you can get it. There's going to even more of a deal off from there. So just keep that in mind when you're thinking about this type of stuff. So I agree that there are times when it's more likely that you're going to have a bargain, when it's more likely you'll find inefficiency, but you're never going to, it's going to be, not never, but it's going to be very, very difficult to know if you're truly at the bottom, if you've truly gotten the best thing you can get, because it's scary. And even right now, people are like, oh yeah, the bottom was in June. And right now we're within a couple percent of that bottom in the United States again. So we're back to where we were at like the lowest point of the year, and it could go lower. And I haven't even checked the markets today. It might be lower, or they're opening right now. So we can kind of wait and see.
So Kailash,
Yeah, they're down 1% right now. Markets are down 1%. They're getting close. I think S&P 500 is within 100 points of being at its bottom again. So, this could be happening today. We could see the new bottom.
Yeah.
Yes, sir. Actually, and last thought. So, yes, sir. Last thought, sir. As you talked about the health also, actually, other than the wealth, actually, you talked about the health also. So, any thoughts on Naval Ravikant? Actually, if you can talk about.
I'm sorry, I couldn't hear.
Naval Ravikant of Angel Investing. Naval Ravikant.
Oh yeah, Naval. Yeah. Okay. So, what about? I don't have any. Like, he's great on Twitter. He's got a lot of smart ideas. I have nothing against that. He wrote this great thread, like how to get rich without getting lucky. I think everyone knows about that. So, I don't have anything against him. I don't have any. I think he's a very smart guy. He knows his stuff. I don't know what his exact investment philosophy is. I think he's more of a tech worker. So he's thinking like, you got to get into a startup, build equity through your businesses and kind of go from that. And that's great. I agree with that. I don't think there's anything wrong with that at all. But his investment philosophy is probably all private stuff. He probably has access to deals that many of us don't have access to. So you have to realize, like, this once again goes back to the problem with most financial advice. Not everyone can tell you why. Like, he knows why he's doing well, but he doesn't realize like he has access to stuff that you and I don't have access to. Just like Warren Buffett. Warren Buffett can make deals that you and I can't make. He can get deal, even if we had the capital, even if you had just as much money as him, you could not get the deals he would get because he has a reputation for doing stuff that you and I wouldn't have. So just kind of keep that in mind. So that's the only thing I'll say on Naval. I think he's a very intelligent guy. He's obviously doing very well, but at the same time, like, he may not even realize how much of like that bubble he's in and the privileges and things that he has that most investors would not be able to do, given his background and everything.
That I think, Nick, was the highlight of the session for me when you said this, that you actually, we get influenced by all these celebrities so much that we can tend to not realize that, of course, Naval Ravikant, Warren Buffett, Morgan Housel, many other great, they are all doing great in their own field, but you are not them. You have to understand that, and many things you can't do. That probably was the best point of the session for me. It was really good, really good. So I think Gautam has raised his hand again. So Gautam, you can ask your question again.
Hi, Nick. So I have another question regarding global markets. How connected are they really, like US market and Indian market? How much influence US market has in India?
So I don't actually know the number on this. You could run a correlation pretty easily, and that would give you like some idea. I think markets are going to get more connected going forward, especially on the downside. I think that's when, we talk about diversification. What diversification really means, at least for risk assets, equities, stocks, real estate, all those things, most income producing assets, that's on the upside. That's where your diversification is. It's when things are growing. They're going to grow in different ways, right? But on the downside, most things move together. That doesn't mean everything, the correlation's not one, but the correlations move to one. And if you want an example of this, look what happened in 08, look at what happened, in March 2020. Everything, even great companies, very good companies, got crushed because when capital's flowing out, they start selling everywhere. Because people are diversified and they own assets everywhere, they end up selling everywhere. They end up pulling their money. So things tend to move together. And as investors get more and more diversified, we're going to see that these markets should move together, right? The reason why, like, for example, they don't move more together is because we're not as diversified. If we were even more diversified, in theory, if everyone had the same portfolio, we would all, everything would move together forever. But of course, that's not going to happen. But you get my point, right? It's like, it really, diversification matters. And because people are getting more diversified, I think over time, we're going to see even more of this type of movement, especially on the downside.
Okay, thank you.
I don't see any more hands being raised. Any more questions from anyone? Okay. So, Nick, that brings us to the end of the session today. Thank you so much for sharing your time experience and wisdom with us. Any closing comment you would like to give to us, or any piece of advice for our Mission Smile community? Let me just spell it out. Mission Smile stands for making, M for making, N for new, stock market investors learn it through engaging research. So that is the whole purpose of our community. So any last thoughts which you would want to share with us?
Yeah, I mean, I would say just guys keep doing what you're doing. Enjoy the process, enjoy the journey. I know, I mean, yes, we talk about money a lot and this and that, but at the end of the day, like it's just about enjoying your life. So I would say try to enjoy it. You know, don't over obsess it. Don't get me wrong. I write about money every week. I couldn't be more obsessed, right? But at the same time, you know, try to enjoy your life. So that's it. And then by the way, if anyone has questions for me, if I know there might be more questions in the chat and stuff, feel free to DM me on Twitter. My DMs are open. I answer everyone. It's dollars and data, all lowercase dollars and data. You can find me there and just send me a DM, and I'll be happy to answer any questions you have in case we couldn't answer one today or you think of one later. So I'll be happy to answer them all.
Thank you. Thank you so much, Nick. And thank you so much, everyone, for joining in and asking some really good questions. Hope to have this kind of a session again with you sometime soon. Thank you so much again, Nick. And thank you, everyone.
Thanks again. Thank you. Okay, appreciate it. Thank you, everybody. Thank you for the questions. I appreciate that. Thank you for your time.